Alright, welcome everybody to the After Hours channel. In today's video, we're going to be diving into my comprehensive investment strategy for 2024. In this video, we're going to be covering a lot of different aspects of investing, which I think are fundamental in growing your portfolio. To do this, I'll be breaking down every step of my investment strategy and what exactly I'm looking for. And at the end, I'll be discussing exactly how I'm going to try and take my portfolio from its current value of $93,000 all the way up to $150,000 by the end of 2024. If this sounds like something you're interested in, then stick around, sit back, and I hope you enjoy the video. And of course, before we kick things off and we get into it, let's do a quick portfolio update. This is the all-time view right now. So all-time, my portfolio is up $32,000 or 53%. It has been an amazing year. I just posted a video about it. Feel free to watch that if you like. If we switch my performance to the year, you can see that I am up 47% or $29,000. As always, if you guys are interested in what holdings I actually have in this portfolio, they are right here on your screen. Feel free to pause the video or take a screenshot if you like. But from now on, we're going to be diving into my investment strategy going forward. For the first segment of this video, we're going to be talking about increasing cash flows. Our journey begins with companies bolstering increasing cash flows, a fundamental metric for sustainable growth over time. It's about laying a solid foundation for success. One company I chose to highlight this metric is my new holding, United Health Group. When we take a look at the cash flows of this company, I really do think they speak for themselves. Even if you're not an informed investor and you haven't been doing this for a while, you can take a look at this chart and realize that they are making more money year after year. If you guys are unfamiliar with what free cash flow really is, it's essentially what the business has left over after paying all their operating expenses. So I like to think of it as how much money they actually have, not including the cash on hand. Using United Health as one of my examples, we can see that in the last year, they've increased their free cash flow by almost 9%, and in the last 10 years, they've averaged out to almost 15%. I want sustainable, consistent free cash flow. I want juggernaut businesses that have such a foothold in their industry that it's like a well-oiled machine that they can increase their cash flows effortlessly over time. Another part of my investing strategy is none other than industry-leading companies with a very unique position in the market. To highlight this example, we're going to be looking at one of my holdings, which is Vici Properties. Some of you may be familiar with this, but others may not. To highlight the uniqueness of Vici Properties, we can just jump over to their website and look at some of the key factors that they display for their investors. Vici owns 54 dynamic gaming destinations. Most of those are actually on the Las Vegas Strip, which is one of the things that drew me to this company. Another 39 properties and 4 championship golf courses located across the United States and in Canada. If we take a look at the map of all the properties that Vici currently owns, you can see them right here. It's a pretty diverse portfolio of real estate properties. If we take a look through the website and we just keep scrolling down, you can really see all the properties that this business owns. I mean, it really is impressive. Just to look at a few of their properties, we have Mandalay Bay, which is arguably one of the nicest hotels in Las Vegas. Not only that, but we have the MGM Grand, which I believe is one of the largest, if not the largest, casinos in the world. Some other properties we have right across the street, we have New York, New York, which is an iconic landmark of Las Vegas. Next to that property, we have Park MGM, which is another great property, and Prime Real Estate. And lastly, to cap this off, a few other properties that they own on the Las Vegas Strip, we have the Mirage and the Venetian, both Prime Real Estate as well. And the Venetian, again, is one of the top rated resorts in Las Vegas. It's absolutely beautiful. The rooms are always nice, and they have one of the nicest gyms I've ever seen. So when we're talking about companies with a unique position in the market, this is what I'm referring to. I'm willing to sacrifice some other financials to buy into a company like Vici because they have such a foothold on the Las Vegas Strip and other gaming institutions across the United States. Another aspect of my investing strategy going forward is reliable dividend payers with regular increases. What better company to use as an example than Visa? Not only is this a great business with an extreme foothold in their industry, but they're one of the best dividend payers in my portfolio. Multiple times a year, Visa raises their dividend, consistently paying out paychecks to you as the shareholder. Stability comes from reliable dividend paying companies, especially those committed to regularly increasing their dividends. This adds a reliable income stream to our portfolios. So not only are you getting the capital gains of your investment when you're buying into the stock, but they're paying you regularly. Taking a look down here at the bottom, we can see that in the last year, Visa paid an increased dividend of almost 16%. And in the last 10 years, the average was almost an 18% increase. So when I'm talking about buying into companies in the future, I'm looking for reliable dividend payers. I'm looking for companies similar to Visa, not only having the financials to back up the investment into it, but a company dedicated to rewarding their shareholders. Next on the list, we're going to be talking about prudent debt management. When navigating the financial landscape, I prioritize companies with prudent debt management, ensuring my investments are shielded from unnecessary risk during economic downturns. What better example to use than Microsoft? Microsoft is one of the largest holdings in my portfolio, if you didn't know that. And when we take a look at their balance section right here, we can see that they have $102 billion of cash on hand. Now, believe me when I say this is far and few between. There's not many companies out here with that amount of cash on hand, but this company truly embodies the fact that they can manage their debts so well. When I make an investment into a company like this, when I see that amount of cash on hand, it really does ease a lot of my stress. If we're heading into a recession or an economic downturn, like I mentioned, I know that a company like this with over $100 billion of cash on hand can easily weather those storms, and they also have the cash to make new acquisitions if a good deal presents itself. And lastly, it's always great to have a company with a ton of cash on hand because they typically reward their shareholders. So going forward, this is something I'm going to be looking for in the future. I want companies that prioritize their debt management. The next segment of my investing strategy going forward is share buybacks. Strategically, I embrace share buybacks as a signal of confidence from company management. This not only enhances shareholders' value, but aligns with my goals of creating a resilient portfolio. So for the example of share buybacks, we're going to be looking at none other than Apple. Again, another large holding in my portfolio. We can see that since 2012, Apple has really put share buybacks at one of the top priorities they have. In the last year, they've decreased their shares by over 3%, and in the last 10 years, they've decreased it by almost 5%. Now, that might not sound like much when I put it in those terms, but let's look at 2023. They had 15 billion shares in 2023. When they started their share buybacks, they were at 26 billion shares. So this company was virtually able to take off nearly 11 billion shares from the market, further increasing their shareholders' value. So going forward, I'm looking for companies that emulate Apple and their share buyback program. Another segment of my investing strategy going forward for 2024 is non-cyclical businesses. In uncertain times, non-cyclical businesses serve as anchors, providing stability and a reliable revenue stream irrespective of economic fluctuations. So when we're talking about non-cyclical businesses, I like to use United Health as another example. If we look at the last huge downturn that we had in 2020 and 2021, we can take a look at United's revenue right here. Not a change. If anything, it actually increased. So while other companies' revenues were dropping like crazy, because they weren't positioned for the downturn that was coming, companies like United Health weathered the storm and they were appropriately positioned to handle anything that was coming. Not only that, but if we take a look at their free cash flow, we see the same exact thing. Their cash flows did not drop off a cliff like many other companies out there, further highlighting the fact that this is not a cyclical business. If there's a downturn for 2024, I can rely on this company to continue its operations as normal, return money to me as the shareholder, and continue increasing their revenues and free cash flows. This brings me to my next point, and that is I'm looking for companies that can withstand a recession. My portfolio is fortified by investing in companies built to withstand a recession, ensuring my assets remain robust even in challenging economic climates. When I have companies like Microsoft in my portfolio, I know I'm good to go if there's a recession. This company has over $100 billion of cash on hand. So going forward, one aspect of my my investing strategy that is paramount to me is looking into businesses that can withstand any economic climates, specifically upcoming recessions. All of these stocks right here, I feel that they could fare well in an economic downturn. The next segment of my investing strategy going forward is none other than emotional discipline. Now, here's a critical aspect often overlooked: emotional discipline. Successful investing involves leaving emotions at the door. By sticking to our strategies and avoiding emotional decisions, we can ensure a rational and calculated approach to wealth building. If you guys are unfamiliar with what you're looking at right here, this is the CNN Fear and Greed Index. This index was actually updated today, so it's pretty accurate. And if you can see, we're in the extreme greed category. I posted this last night on my community section on YouTube, and I just reiterated a quote from Warren Buffett. He says, "Be fearful when others are greedy, and be greedy when others are fearful." Now, what I'm trying to signify here is the fact that just because there's other people out there making money, or at least you think they're making money, that doesn't necessarily mean you should jump into the market or buy that hype stock that they're talking about. Emotions work both ways. You have FOMO, fear of missing out, so when that stock is racing up and you don't want to be the only one not making money, and then you also have the fear aspect of investing. When your portfolio is down tens of thousands of dollars, which my portfolio was the first video I ever made, I was negative $17,000. And you know what I did? I made a video about investing in a bear market. I held true to my strategies and my beliefs and the companies that were in my portfolio, and I weathered the storm. Now my portfolio is up over $30,000 with an almost 50% gain this year alone. Most people's portfolios would be better off if they bought a stock and never looked at it again, because it takes the human error out of investing, and more importantly, it removes the emotion. So going forward, I want to continue down that same path and remove any emotion I have left from investing. Contrary to many others out there, I am not in love with these stocks. If they're not performing and there's some major changes within the company, they're going to be taken out of my portfolio and they're going to be replaced. And on the contrary, if there's a huge drop in the market and I don't think it's justified, I'm just going to buy more. I look at that as an opportunity and a discount to increase my positions in great companies. So going forward for 2024, leave your emotions out of investing. Now, to wrap this video up, how do I intend to take this portfolio of $93,000 all the way to $150,000 for 2024? Well, I broke it down in a pretty simple way. First, I want to commit to investing around $3,000 or more a month. Now, this could change at times, but I would like to stay around that same number just to really start that snowball effect even more and see the growth of this portfolio take off. For the remaining $21,000 or so, I'm hoping to accumulate that through gains and dividends. Now, the dividends probably aren't going to play a huge factor. We're only going to be talking about a couple $1,000s, if that, especially because a lot of the companies I own do not pay a substantial dividend. But I'm hoping that this disciplined approach aims for sustainable and significant portfolio growth going forward. So in conclusion, this strategy is built on a foundation of growth, stability, valuation, awareness, and emotional discipline. If you found this video helpful, don't forget to hit the like button and share your thoughts in the comment section below. And of course, subscribe for more insightful content in the future. I'm staying optimistic for 2024, even though there's a ton of negative news out there and fear magnifying articles that only scare uninformed investors out of the market. Whatever happens, I'll be including you guys along the way, so stick around and I hope to see you in the next one. Take care.